If you're struggling to get the correct trading direction and want to know exactly where the market is turning, today I'm going to show you my simple and mechanical process that I use that you guys can implement today. I've been trading for the last 10 years and I'm very, very good at putting complex information into simple and repeatable steps. Welcome back to all the subscribers and welcome back to anyone who isn't already subscribed. Make sure you do click subscribe for the weekly price action videos. So last video, we spoke about having a higher time frame range on the charts on the left, followed by initiation here to the downside. And when we come back into this location in the future, this is where we're looking to zoom in to the charts and look for our continuation structure. So we're going to add to that this week, right? I'm going to show you exactly what I do and my process for it. So let's just recap really quick, right? When we're thinking about where price is reacting from, where we are now or where we previously come from, this is going to help us to build our narrative and our understanding of direction within the market. Now, I only use 2 time frames. One higher time frame, so typically like a monthly, weekly, daily, or 12-hour, any of those time frames, because the higher the time frame, the more likely price is to move, number one, further, and price is number 2 following that narrative on the lower time frame. So if we're bullish on the higher time frame or we're into a bullish mitigation of a sideways range on a higher time frame and price wants to change its direction, you're going to see continuation structure away from this location on the lower time frame. Just like where we are now, we're coming into a bearish mitigation here. So what do we want to do? We want to look for price to slow down. How does price slow down? I'll show you in a second. And then the second thing, we want to look for continuation structure away from this location to show that price wants to move in the opposite direction. That is all you need, right? One higher time frame, so one of those 4 time frames, so that you can trade with a higher time frame narrative. And then your entry time frame, whether you use the 15-minute, whether you're going to use the 1 minute, whether you're going to use the 1 hour, it doesn't matter, right? All that matters is that you can read continuation structure away from a higher time frame mitigation and you can see price slowing down. So that is the purpose of today's video. I'm just going to go through my process of understanding exactly how to read multi-time frame analysis and then look to get involved in opportunities. So we're going to start here on the 12-hour as we always do. 12 hours is one of my favorite time frames because first of all, you're going to get the day split into 2. So the first part of the day is going to be a reflection of what the second half of the day could look like. So typically if we start to move slow or we get a doji candle in the first 12 hours, typically the next 12 hours is going to be some sort of initiation in either direction because this is range and the next phase after a range is always an initiation structure, right? Which gives us an understanding of what New York could look like. So where is price reacting from right now? Well, we just saw this on the weekly. We can see a doji candle here. This candle right here is a doji candle. So we're just looking to take the lowest point all the way to the highest point here and drag it across. Now, this is what I said when I say I look for sideways range on the left and initiation here to the downside. I don't care that prices come back into this location already. It doesn't matter. It's still going to react out of this location in the future because this whole range has not been taken out yet. If price runs above this area, then of course we can't play this location anymore. The price has invalidated this range to the left. So this is the first part of the RAMC model. This is what we're always looking for first. Sideways range on the left hand side of the charts. If you don't know how to read a sideways range, make sure you take the Trading Missing Pieces course because it will break down everything for you. Then we see an initiation. That shows us the direction of the range here. And this price delivery right here is what we're looking for on the left-hand side of the charts to give us an understanding of where price is reacted out from. Now, here we can see that we got a reaction. If we look left, we can see that price is contained sideways before we broke out here to the upside, right? So now we're between these 2 intentions within the market. Let me just draw this on here. Now, because we understand the RAMC model, that says that price is going to pull back into a previous sideways range. Here we get a reaction, or this is where we're zooming in, which we'll do in a second on the lower time frames, and you can see my process. Then if we follow through, we're going to target the low that was created by the sideways range. So you can see that this sideways range created this low down here. So if price reacts from this location and continues, we are going to see bearish continuation structure into this low, and that completes that bearish order flow pattern. If, however, price is going to see a move into higher prices, then this range here has created this high. Yes, it's taken ages to come back into this location. It doesn't matter, right? Time doesn't matter in the markets when we think about ranges because there's ranges all the way back from when the market started that are still left unmitigated, which will still see reactions in the future. So this is then the high. So if price reacts from here and follows through, then this reaction that we're getting in price right now will be a short-term selling opportunity for a longer-term bullish continuation that's going to target this high. Now we've already, just with the one concept of the RAMC model, we've mapped out an area that we can sell from, but also understanding that if it's short-term, then we have our higher time frame target here to the upside to see continuations. We are mapped out just on one higher time frame using the RAMC model, exactly what we could be looking for and exactly what we can trade. That right there is the power of the RAMC model. Just using one higher time frame to understand direction and understand where we're playing our ranges from and intention, and now we can move into the lower time frame. So now we are down onto the 15-minute chart. I've just zoomed out so you can see all of the price action that we see here on the 15-minute chart. This is one massive sideways range here at our point of mitigation. And like I said, when price comes into a higher time frame mitigation, we're typically going to slow down and overall move sideways. And that gives us an understanding of price wanting to turn from this location. Of course, let's just go up to the 1 hour here as well, just so it looks a bit cleaner. What we can do is put on our location tool from the highest point of the range to the lowest point of the range, and we then can look for the best trading locations here inside that range to play continuations away from, and then we can follow that higher time frame swings, A to B swings within the market, and then we can make sure that we're buying low, playing continuations here to the upside as well, anticipating that breakout. And we can also get involved in some short-term sells here to the downside as well. We don't know that they're short-term, but they can become, they're essentially, they'll be short term right now because we're out of a higher time frame buy mitigation, but they could turn into long term if price just ended up continuing to the downside. So it's almost like, cool, we're at great locations to take sells from and to take continuations away from, and we understand that this is a great location to trade from because we've got a previous sideways range here as well on the left hand side, initiation. We're coming back into that point of mitigation in the future, so we can zoom in here, and I will zoom in and show you my process here as well. And we can trade those as continuations away. And of course, because this is happening on the higher time frame, these moves to the downside are hundreds of pips, right? We're only looking for between 20 to 40 pips worth of move to take massive profits out of the market. So all we're doing again is just using that same process. And then when we eventually break out of the sideways range, we're now in a new structure, right? Because we understand the RAMC model, we understand after sideways ranging markets comes an initiation. So when we break the high aggressively, now we know that we have clear direction here to the upside. And because we're from that higher time frame range from the weekly chart, now we have really clear direction in the market here to the upside as well. So we would only be looking for buy continuations. This is how we're utilizing multi-time frames together, just to understand where price wants to go, the best locations, and then trading alongside the correct intention within the market as well. When people talk about the market changing, right, the market is only going to change in these cycles. Ranging markets, initiation markets, trending markets, or back to ranging markets. These are the only phases of price. So once you can understand the RAMC model, you will understand every single market change. I don't care if the market changes in 2 years, 3 years, 5 years, it will only range, trend, or initiate. So if you understand all of these, and obviously volume changes as well. Typically, if we're going to break out of a sideways range, we're going to see higher volume, right? So those are the two things that happen. We volume change from a low volume, which is normally a sideways range, to a high volume market, which is always an initiation market. And then we change from ranging markets to trending markets to initiation markets. Those are the only changes that the market will ever go through in your whole trading career. So once you can start to identify these, then you can start to anticipate them before they happen, which is this, the next stage. And then you can look to trade continuations away and have a system that works in all market conditions. So enough chatting, because we've been chatting for a while now, and let's actually look at this process, right? So let's use this area right here, which is what we were looking inside NJT and what we went over last time. This is our previous sideways range here on the left, where price is contained sideways between the low point and the high point before we broke out to the downside. So we know that this is an area in the future here that we can look to trade away from, and continuations away from this location. So let's just draw that all the way across here as well. Now, it's important that this happens during the sessions so that we can trade continuations during the sessions. But let's go down to the 15-minute chart. So we already have our area on the left-hand side of the chart. Now, all we want to do is look for continuations away. And this is always part two of the process. Part one of the process, higher time frame, look for your sideways range, look for your initiation. Part two of the process is always go to your time frame that you want to trade from and look for continuation structure. Now, what forms of continuation structure can we get in the market? Well, we can get a trend here, A to B, continuations to the downside, lower highs and lower lows, as everyone sees in the market. That's where we can look for price to break structure here to the downside. We can look for our 50% pullbacks in these A to Bs here. And then we can look for our ranges to the left using the RIMC model and use the same process, right? Range on the left, initiation, on the right-hand side, mitigation and continuation of that trend in the market, right? Very simple process that you can use and build a strategy from. The other way that we get, which is sometimes the opposite way, is price comes up into this location. We move very aggressively to the downside. We range and then we continue and then we range and then we continue. Typically on the higher time frame, you'll just see very big bearish candles printed in the market, and this is what it looks like on the lower time frame. So that's the second thing that can happen. The third thing that could happen, which is also a form of continuation structure, is we initiate, we pull back, we run below that low, then we run above that high, and then we continue. And typically this is a more complex structure within the market, but it's still continuation structure because we are still moving to the downside, right? As long as we are moving to the downside away from a higher time frame mitigation, we are in continuation structure away. This is the perfect setups that you want to look for in the market. This right here is also something to be aware of. I literally just made a video on this inside NJT. It's called How Did We Break Through the Highs and Lows? This is extremely important to understand to trade this market, which happens probably 80% of the time. So that you can stay one step ahead of where to look for your trades in terms of the location and get involved in the best opportunities with the highest risk rewards. It's about reading this price action, which is so key, especially in the markets that we're in right now, because this is more likely to happen than this. So you want to be able to trade continuations and multiple ways of trading continuations so that you can have a sustainable strategy. You don't want to be waiting for ages to get this market structure that only happens 20% of the time, and then getting stopped out of trades, not able to get any profit on the moves that you're understanding. So we need to understand all of the continuation structures away, and that is why I created that video for NJT, which is out this Friday. But typically we can see when we're moving to the downside, we want to be understanding how price is running above highs. When we get strong rejections of higher prices, that helps add to our narrative and our understanding of continuations to the downside because price is coming from a higher time frame location, right? So let's just look at the price here coming from this point of mitigation. What do we see, right? We're just looking for continuation structure at our higher time frame mitigation. We do not need to guess the top. All we need to do is read the swing points, read the breaks of structure here to the downside. Now, if you're asking yourself, well, do I take this as my A to be here? Then do I look towards the edge here or do I look towards the 50%? Watch the How Did We Break video. Then you will understand exactly where to look for your trades every single time. Now, we're just in continuation structure here to the downside as well. We get this lower high here and lower low, lower high and lower low, so on and so on, right? We get many opportunities within this move down to play continuations. Like I said, this happens outside of the session here, but we run above that high, strong rejection, continuations back down. That creates that new high and new low in the market, all the way down until we react from here, and then we start our new direction here within the market. Now we've reacted here and we started moving to the upside. So look left, what is price reacting out from? A previous sideways ranging market here. This is a higher time frame range. It's a higher time frame range because it's massive. It's a massive area. We've broken out here to the upside, created the high. We pull back into this range in the future, and now we can see continuation structure away from this location. That gives us our narrative and our understanding of the direction within the market. And like I said, all we're doing is just looking for the same process, right?